This is your Wall Street wake-up call after steep declines in the markets yesterday. Stocks are stabilizing Wednesday. And for more, let's get straight to Maximilian Kunkel. He's a cross-asset strategist at UBS Wealth Management based in Zurich. So, Maximilian, what a few days it's been. We had declines last Friday, gains on Monday, and then declines on Tuesday. Perhaps more gains today in U.S. stocks?
Probably yes, and I think also if you put all of this into a broader spectrum, volatility is clearly back from a summer holiday. We think though that number one, volatility is likely going to be here to stay with us, but I guess more importantly also this bond-led sell-off that we've seen just now, in our view, is just another one of those bond-led sell-offs that we've seen since the taper tantrum in 2013 and is going to be relatively short-lived. So more gains to come gradually over the next few weeks and months.
All right, now, would you agree that we're sort of in this wait-and-see kind of mode? Of course, we have the Bank of England meeting tomorrow, and then we have the BOJ and, of course, the Fed next week. If we don't get any more stimulus from these central banks, what happens to stocks?
So I guess that's the key question, specifically when we're talking about the BOJ, because one of the things that has gotten, understandably, investors very, very nervous after this month-long PE expansion rally that has been driven largely by ever lower yields that you could get from government bonds, is whether or not this is going to stop through this sudden increase that we've seen in borrowing costs on sovereigns. Specifically here, we should be looking, in our view, on the 21st of September at what the BOJ is doing. In our view, the Fed is not going to increase interest rates, not going to add any stimulus in any case, but clearly the BOJ is going to be key here. Why? Because what we have seen over the last few months is that both JGBs as well as bonds have acted as an anchor to treasuries and kept them very low. And at the same time, what we've seen recently is, since the end of July until just now, a major move upwards in yields on JGBs on 10 years. So from late July until just now, we've seen a move from minus 30 basis points to just minus 3 basis points. And of course, without any further stimulus, in particular, credible implementation of that stimulus from the BOJ, that move could go higher, which would, of course, negatively impact stocks in the short term.
Well, because you can make the argument that last Friday's declines in U.S. stocks, where the Dow dropped 400 points, was driven in part by, inaction from the European Central Bank meeting the day before, and a lot of investors were hoping for more action. So we're sort of set up for yet another situation like that if the BOJ doesn't come through.
Yeah, absolutely. But I think that's also why it's in the short term in particular so critical to look at the BOJ. But if you're looking at it from a broader perspective and not just looking at this specific meeting, is that the overall environment continues to be one of low growth, low inflation, and accommodative policy, generally speaking. So much of what we've seen over the last few months and quarters should stay intact.
Maximilian Kunkel from UBS Wealth Management in Zurich. We'll leave it there. Thank you very much for joining us. I'm Scott Gamm, and you're watching The Street.